Hello, DR.
Richard, it's great to see you this morning. I must say, I was heartened to see that quite a few people wanted to hear what you were thinking is moving the markets last week, and so here we are again to take another swing at
That's why we call it market moves.
it.
And it's
Indeed,
been another interesting week in the markets, to say the least.
it has. It has. So maybe we should even jump right into what is moving the markets. Would that be okay with you?
Absolutely. Let's do it.
I think the first thing that everybody is talking about, and I'm going to show my screen here while I talk,
Please.
is that every time somebody mentions anything about the debt ceiling, that is what we're hearing about. So let's let's see if I can get this screen up, and let's look at a chart of the S&P. This is just the spider, the ETF, and
Yeah, can we actually, I think you have another chart showing the last big debt ceiling fight back in 2011, right?
I
And
do
to me, it
indeed.
gets at what is really the most interesting question to me, because there's this, I'm always looking for what ideas are out there that are going to fail and be reversed. And one of the big ideas out there right now is that resolving the debt ceiling crisis is going to lead to a market rally, right? McCarthy and Biden
Yep.
are going to shake hands and it's going to be woohoo. Finally, we're untethered. The market can be off to the races. So I think that might be an incorrect idea. And I think this chart here is from 2011, the last big debt ceiling fight. And, for 7 months leading up to Obama and I don't know who was the head of Congress at the time, Boehner, maybe, shaking hands on the
Correct.
debt ceiling resolution. So where did that happen in
That
time on this chart?
real time in this chart, it was right at the end of July. I think it was the
Right. So I
27th or
think,
the 29th. So it was one of these bars in here. Yeah.
yep. And so this happy day was not met with the outcome that, investors are hoping for today.
Yeah. And
So
for people that have the memory of what happened 12 years ago, Richard, we S&P had threatened, the Standard and Poor's rating agency, not the market,
right.
had threatened to drop U.S. Treasury rating, and they did so. They finally did so on this day right here.
Yep. So I
And
really don't think that something like this is out of the question. I certainly am keeping powder dry because I'm concerned about this kind of event. We did our financial crisis summit over at the FSC a couple of weeks ago.
right,
And, myself and my colleagues at the foundation all see risk into September. Doesn't mean it's going to happen, but it's an elevated risk. And
I
so
love.
exactly how this played out in 2011, I think it could play out this way again. And if we jump to the chart, of 2023, just like we were range bound here in 2011, we are range bound for the past 7 months here in 2023. The S&P's been just bopping back and forth between 375, 380 at the bottom and 420 at the top. And if we do get a breakdown out of that range from the top, we could head all the way down to 340, 330, and just be doubling that range, right? But that would be like 25% drop in the S&P 500. So I really, I can't in good conscience rule that out. I'm aware of all of the bullish forces that are in play right now too. I've never, minced words that it's a time of uncertainty. It's a time that got to be vigilant and I think still defensive. So I think it's going to be really interesting to see what happens on Tuesday. And just because McCarthy and Biden shake hands and Congress passes the legislation and Biden signs it, doesn't mean necessarily a happy outcome for markets.
Yeah, there's another similar eerie parallel to add to the uncertainty, and that is that Fitch's announced that U.S. government debt was under review, one of the other three big major rating agencies, just a couple of weeks ago. So very similar parallel to 2011 there again. So we've got the debt ceiling is doing that, and while the debt ceiling has been in front of people's minds, behind the scene, Richard, we've had some monster pops in rates. I'll throw up a chart very quickly here of the U.S. of U.S. very short-term treasuries, and what has happened this week over here. We've gone up to 5.73 one day. The actual kind of investable rate, 5.8 on 5.8% for a 1 month T-bill. That's just incredible.
And that kind of volatility, like more or less in the equivalent of a money market fund, that cannot be good for financial stability. It can't be good for banks when depositors are going, what? I can make 6% on a 1 month T-bill? And you're offering me, 1% up from 0.1%. So there's still pressure from the inverted yield curve on the banks. Another reason that I am not comfortable that we are out of the woods and about to be off to the races, even though, there's a lot of money managers who are going to be having to chase this rally soon. I think we could get a breakout. I think it'll be a false breakout, a fake out myself.
Right.
But you shared these moves in 1 month T-bills, and that's even, they mature in like 2 weeks on these things, is really not the essence of financial stability. Let's just put it that way and leave it at that.
No, but I think it impacts the next group that we wanted to talk about, Richard. Another big market mover this week has been the stock of NVIDIA. And, NVIDIA just exploded. We'll just go ahead and pull up a stock while we're here. There's NVIDIA. And if you're going, well, that it looks like a good uptrend. It does.
There's a bar way up there.
Yeah, until you figure out that sitting up here is Thursday's trading day, 25% above where it closed on Wednesday.
And it wasn't just NVIDIA, Google was up, Microsoft was up, the Chat GPT generative AI story is continuing to separate the haves from the have-nots once again.
Yeah.
Right. So we talked last week about the 8 stocks that made up 26% of the S&P 500, I think.
Yes.
The 8 tech stocks, right? And I bet if we did that calculation, it would be even more.
It is even more. It is even more. As a matter of fact, it's up over, I think it's over 30%. I looked at it at the end of the day yesterday, and well over, here's a big kicker, well over 50% on the NASDAQ 100, the NASDAQ composite index, the Qs, or any of the composite indexes that we look at.
This is just crazy. This is crazy. And I think, DR, it connects to the debt ceiling conversation too, because I think that, there's a flight to safety to these big cash-rich technology companies that are holding hordes of cash that I think investors are thinking they're even safer than treasuries at this point. It's like big tech has become the new treasuries in a way. And moreover, these giant cash hordes, they're able to actually take advantage of these short-term interest rates and make money on T-bills, you know? So it is a perfect storm for big tech, a perfect storm of profits, a perfect storm of cash at the right time, you know, a perfect storm of the AI hype cycle kicking in. And we continue to see essentially 8 stocks. I mean, almost holding up the entire market. I think the Russell 2000, right, all the small cap stocks might have even been down yesterday, you know, on the day when the NASDAQ was up. Is that the Russell 2000 right there?
Yeah,
look at that. It's down for the last 3 days.
Wow. That
While everybody's just looking at the NASDAQ going, you know, rah, rah, McCarthy, Biden, you know, thanks guys for resolving this and unleashing the economy. But that's not what's happening. You know, we're seeing a very narrow rally. It's not carrying the market as a whole. The S&P keeps bouncing up against 4,200. So this is a time of caution.
And if anybody, if anybody was thinking that investors and traders were jumping into a risk-on trade, you need to look no further than this chart.
This is not a risk-on.
It's not
this is not a risk-on rally right now. You know, I mean, if you want to say NVIDIA is risk-on, okay, you know, but NVIDIA is benefiting from what I call, you know, the gamification of everything.
I love your description of that, Richard, that it just makes so much sense.
I don't think that humanity wants to live exclusively in a gamified world. And I think part of the reason the economy is becoming so gamified is because what computers are really good at is games. Computers are really good at games, right? Computers can beat us at chess. Okay. You know, so what? Chess doesn't put food on the table. Chess doesn't put fuel in the cars.
Right.
You know, chess isn't real life. It's a game. And computers are really good at games. And so all of these companies that are built on computing power benefit from the economy becoming more and more game-like.
And it's interesting that the big
sustainable.
I think that it's so well put, Richard. And the interesting thing is that the real stocks that have been getting the biggest lift, like NVIDIA, AMD also was way up yesterday. Another big data center chip provider. There's their bar up here at the top. Are the picks and shovel companies. They're actually making something a little bit real in this economy. They're actually making chips or designing chips. So that's an interesting twist. It's not a pure risk-on play, as you've already said. But there's interesting in what you've been talking about. We'll look very quickly, and then I know you have some things you want to show us. Look very quickly at this is the NASDAQ 100 index. This is the QQQ, or this is actually the index, NDX, and we'll look at, you know, what's been going on. It's no surprise, but NASDAQ at the same time, NASDAQ up huge. Since for sure since the end of April.
Yeah, actually March. I mean,
and now the equal weight, the NASDAQ that is not weighted by capitalization. That's what this number is here.
Right.
The NASDAQ equal weight is down actually a bit since the beginning of April. So a big discrepancy, a big divergence in what's going on in those two indexes.
So basically, again, you know, 8 stocks in the NASDAQ are driving the rally, and the other 92 in the NASDAQ 100, I guess, are lagging. And so when you equal weight them, the NASDAQ ain't going up.
Exactly.
So
Exactly.
look,
Really holding ground.
let me just jump over to my screen for just a minute
You got it.
in here. And I just want to show people how I think
Hmm.
in these kinds of situations, because I think that, we're in a time of heightened volatility, right? And this move in NVIDIA, 25% in one day, $200 billion, add to the market cap all in one day. Okay. That's a very disorienting move for
Wow.
investors, right? And I think, that's a big part of the gamification of markets is you get these moves that really like destabilize everybody, and make it like your head, like what do I do? What do I do? Right. And that's what we have to be really careful about. So this is a chart just of NVIDIA here, and this is a histogram. It's showing the, like how many days over the past year has NVIDIA been up, 0 to 0.5% or 0.5% to 1% versus down 5% or up 5%, right? So lots of big moves in NVIDIA, up 5% in a day, some big moves down 5% in a day. NVIDIA's a fat tail stock, right? So
Right.
very hard to make sense of this when we're used to normal behavior,
Hmm.
which is like the bell curve, with most of the up days being small and, big days being few, right? I mean, many small up days, fewer and down days, fewer large up days and down days. So, if you're just looking at NVIDIA and you're just in this one stock, you should expect a 6% move at least once a month in the volatility, a daily move of 6%.
I
So
love I love the information that this chart gives us, Richard, that it's very data rich, even in terms of something that we don't normally see.
yeah, so I like to build portfolios, of relatively uncorrelated bets. Look, I like NVIDIA here. I'm not going to deny it. I'm not crazy about the gamified economy, but NVIDIA is building the picks and shovels for the gamified economy, and I don't mind having it in my portfolio. Okay, maybe I'm not going to put Google and Microsoft in there because I think they're manipulating the gamified economy, but the picks and shovel makers, okay. But, United Rentals is one I've been looking at. I like Adam Johnson over at Bullseye Brief. I think he's got a great newsletter. And if I add this stock to this portfolio, my volatility for just NVIDIA was at almost 6%.
Hmm.
Combining these two stocks brings that down to 4%, right? United Rentals, another picks and shovel business, right? On the financial side, I think Schwab is interesting at these levels. I think Schwab's been around for a long time. It's down quite a bit. I think
Yeah,
it's an
really beaten down.
opportunity. But look, if we add Schwab to this portfolio, okay, our volatility comes down even more, 3.7%. Our diversification's going up 14%. Another one that Adam Johnson turned me on to, EOG Resources in the natural resources space. Let me add that to this portfolio here. Now our volatility is down to 3.4%. It's still high, 3.5% move at least once a month. Okay. That's not something everybody can stomach, but you can see the direction this is going. And my diversification is now up to 22%. Okay. So don't let NVIDIA get into your head, make it so that you don't know if you're coming or going, right? If you think it's still got room to run, by all means, have it in your portfolio, but you've got to get your portfolio into a place that's going to make your headspace survivable right now, right? Because we got the debt ceiling,
Right.
We got, I think, significant risk out through September. We've got this kind of gamified markets environment where these moves happen, they get amplified by the media, people kind of lose their heads one way or the other. And believe me, more of that's coming. That's the mechanism that transfers money from the, weak hands to the strong hands, if we shall say. So I think that's, it continues to be, I think, a very deceptive market, and one where diversification and kind of controlling for volatility is really key. And I think ultimately keeping some powder dry so that you're minimizing your maximum regret, right? So if the market does just take off from here, and I'm wrong, then, hey, you're on board for some of it. But if we do get a correction, you're happy that you've got some dry powder.
I love that direction that you would head in right now, Richard, and would take people in. And I think there's a corollary to that. If it does take off, you can have a get in point. It doesn't mean you're out forever. And having a little bit of powder dry is great, especially when you can get some real returns now. You could get 4 or 5%. In the meantime,
you can be earning 5-6% annual on your cash.
Yeah.
So not a bad time to be an investor.
Great stuff, Richard. Look forward to doing it again next week.
Have a great Memorial Day weekend, DR.
Thanks. You too. God bless you, and we'll catch you on the other side.
Looking forward to it.